Hello, everybody, and welcome to what is actually Solactive's very first webinar, hosted and broadcasted live from the new mothership over here in Frankfurt. For those on the line who don't know me, my name is Timo Pfeiffer. I'm in charge of research delivery here at Solactive. You can expect us to publish and launch more webinars in the future based on white papers, blogs, etc. that you know from us, based on concepts and new ideas developed here at Solactive. It's the first version. As I said, we plan to do more in the future, so please do not hesitate to share your feedback afterwards with ourselves. We are keen and curious to know what you like, what you don't like, what we can improve from here. Before we actually get started on the content, there's a few technical aspects to consider, please. You should be able to listen in and view this webinar on either Teams or in your browser directly. Small note, apparently Safari via Apple doesn't support the format, so there's phone dial-in options available in case you're on some iMac or Apple device. If you have any issues during this webinar, please feel free to drop an email to research@solactive.com. We're monitoring emails in parallel and can respond there. On the screen, you actually have the possibility to post questions directly, which again we will be monitoring, will be picking up, and can respond and pick up towards the end based on the presentation. We're planning to run this for roughly 15 to 20 minutes in total. The webinar will be available for replay and possible for you to share with colleagues or interested parties afterwards. Now let's move to the actual topic, which I believe is quite timely. Renewable energy weighted bond indices. Quite timely after blocked streets here in Friday and many other cities around the globe on back of the Fridays for Future initiative. Also quite timely as we here on the ground, launched by the German government, have published the climate package and agenda plan just last week. We look at the topic, the E in ESG today from a fixed income investor's perspective, namely focusing on alternative energy production. This will be done by my colleague next to me, Axel Haus, who has joined us about 2 months ago and is focusing on thematic, what I call qualitative research delivery here at Solactive. Axel, with that, over to you.
Thanks, Timo. Hi to everyone, and thanks for giving us the opportunity here to talk to you. So thanks for dialing in and being on the webinar. I think the index strategy that we want to produce here is quite exciting from 2 perspectives. So the first is it is in the field of environmentally friendly investing, but it's also a strategy where we get some results that, at least I would say, in the last couple of years were quite profitable. I will come to that in a minute. So let me first give you some background on how this works here. First, I want to talk about renewable energy in general, but very briefly, and about the motivation of this project, and afterwards about the strategy for an index coming from what I will have said about the renewable energy space. So as Timo already said, it's quite a lot going on in the field of, let's say, climate awareness, and climate change is probably one of the biggest issues in the years to come. And we will see how this turns out. I mean, right now there's a lot of regulation going on. So when it comes to sustainable finance, there's a lot suggested by the EU and other authorities. And also, if you look at the International Motor Show here in Germany, just recently there were a lot of protests that we could actually see from our office. So a lot going in the direction of protest, of climate awareness, and also we want to contribute to this field with an opportunity to invest in a product that appreciates the efforts within the renewable energy field. So the title is Tomorrow Never Dies, bond, renewable bond. You see you see where this comes from. Let me quickly go to the background, as I already said, about renewable energy. So when we look at the renewable energy space, The most comes from sun, wind, and water. So this is solar energy, wind energy, and hydro energy. About 95% of the global renewable energy generation capacity stems actually from these three fields. And if you look at the pie charts at the bottom of the slide here on the left-hand side, you see the global energy mix, and you see that it is starting, and it is, yeah, it's okay. A lot happened, but probably not enough when it comes to the sources of energy. So just 32% globally in capacity comes from renewable energy. It gets better when you have these role models here: Germany, Norway, and Canada. In Canada, 68% comes from renewable energy and 55% from hydro energy. In Norway, even 93% comes from hydro energy. And in Germany, we have the wind parks, we have the huge subsidies in the field of solar power, and the combined of solar, wind, other renewables, and hydro in Germany adds up to 54% of the renewables within Germany. So yeah, just on the right-hand side, some facts. I mean, when it came to coal and also the technological progress, we had a lot of fossil energy and not non-renewable energy in the recent past. But if you go back more than a couple of years, let's say even a couple of 100 years, there was over reliability on biomass, so it's of just burning stuff that can grow afterwards, so that also is considered as renewable, and also the wind for the ships and so on. So there was a lot, and right now, because of all the climate issues, it becomes a topic again. So let me just quickly go through what recently happened. So the renewable energy has been growing a lot. So it tripled since 2000. And if you look at the numbers, it's quite impressive to see that solar capacity and wind capacity rose from almost nothing in 2000 to around 500,000 megawatts. So that's in capacity. And now it comes to the costs. A lot of its growth can definitely be attributed towards affordability, and the cost that you see here, I don't want to go through it in detail, but you see that the costs are declining, and these costs are the non-subsidized costs, so pure production in these fields without subsidies. And for wind and for solar, the costs dropped by 69 and 88% respectively over the time frame that we regard here. So if you see this, for sure they will go on. The costs dropped due to improvements in system components and so on, so decreasing supply chain costs, and we definitely think that this will continue. First, because it gets more and more affordable, but also because if you see here on the right-hand side on this slide, like the Paris Agreement, so a lot of countries sign actually in to improve the energy mix and also the climate. Yeah, so there's something, and also the regulation probably will continue to be more strict on the sources of energy that we use. And if you look at the bubble on the bottom right, here it says that research indicates that there is a positive correlation between GDP growth and the renewable energy consumption within a country. There's one paper, if you're interested, just drop me a note and I'll send it to you. In this paper, they even say that the relationship is causal. I doubt it, to be honest, but there is a connection. So there's definitely a connection that says, okay, GDP growth is related to the amount of renewable energy that is consumed within a country. Okay. So far on the background. And also what I just said on the bubble on the bottom right, this is also motivation for us to come up with such a strategy, because we think that if the GDP benefits or if GDP growth is somehow correlated to the energy mix, whether it's causal or not, makes sense to make a strategy out of it. And this is what we've done here. And now we come to the so-called Solactive renewable capacity weighted bond strategy. So the setup is something that Timo already mentioned in the beginning. We focus here on the E within ESG. So what we have in mind is to address economically friendly investors here with this strategy, but also, as you will see, it also adds some benefits to the overall portfolio, and I will come to this in a second. The most important thing to know is that we used a different weighting approach here in this index strategy. So normally, normally bond indices are done with a market cap weighting scheme, so depending on the outstanding debt, and here we did something else. Here we focus on the developed markets, so we took 27 countries within the field of developed markets, and we check for the renewable energy generation capacity within these countries, and we add it up. So we have the total energy generation capacity within these 27 developed market countries, and then we divide each country's capacity by the total amount of renewable capacity, and we use this ratio as a country weight within our strategy. So what we basically do is we just divide each country's capacity over the overall capacity in the field of renewables, and doing this we already have some sort of size control, and we also get a weight that really appreciates countries like, for instance, Canada and Norway that I mentioned earlier. Yeah, and the size, we control for the size because I mean, imagine a very small country probably cannot accumulate massive amounts of renewable energy generation capacity, but within the field that is used within the country, yeah, this is so small countries shouldn't exceed big countries' capacity, although in relative terms there can be huge differences. So having said this, how do we get the data? The country level renewable energy generation capacity is collected from an agency that is called IRENA. So this stands for International Renewable Energy Agency, and this agency is affiliated to the UN, and its focus is to promote renewable energy and to support countries in the transition towards more renewable energy usage in the future. So let us quickly go through a historical simulation that we did for the time frame 2008 until 2019. What we see here on this slide is that we have a greater geographical diversification as compared to a benchmark, and as a benchmark here we use the Solactive broad Global Developed Government Bond Index. And compared to this benchmark, the strategy that we present here has higher weights in Canada, Germany, as well as Norway, and has lower weights in the US and Japan, as you can see on the left-hand side. And when it comes to the currencies in the table on the right-hand side, let me quickly mention just a few of those. Here the euro is overweighted. Also, for sure, the Canadian dollar is overweighted, and we have on average a big underweight in the Japanese yen, as well as a slight underweight in the USD. So having this, we get a bias or a tilt towards quality. If you remember on the slide before, we had a huge overweight in Canada, Germany, and Norway. And these three countries stand for an overweight of around 20.5 percentage points. So 20.5 percentage points overweight in Canada, Norway, and Germany combined. And all these countries had the best possible rating through the time frame that we got here. And when you look at the left-hand side, we just said, okay, well, we made a numerical credit rating. So the highest rating is a 1, the second highest is a 2, and so on. And you see that we had a a higher concentration in quality credit through the time frame that we regarded compared to the benchmark. And on the right-hand side, you see that the duration of the index strategy was a little bit lower during the time frame that we looked at compared to the benchmark. That may have been a little bit of a drag when it comes to performance, but as we see, other factors outweigh this factor here. So we have a little bit lower duration in this renewable capacity strategy compared to the benchmark. So coming to the probably most important result when it comes to the historical simulation, here we see the performance. I mean, you cannot really see that the volatility was slightly lower than the benchmark. So the green line here is our selective renewable capacity weighted bond strategy. And yeah, you see the number in the table on the bottom. The annualized volatility was around 5.1% compared to the benchmark, a little bit over 7%. And yeah, I mean, the reason why we do back tests, right? We want to see how it would have performed. So here you see the annualized returns, and the outperformance on a yearly basis would have been 44 basis points. And so the strategy would have added value to investors' portfolio. In the past, also the drawdown looks a little bit better, and there's no surprise that the Sharpe ratio is also quite good then. And yeah, one more important thing to note here, the index currency is euro, based on this analysis that we did here. And yeah, let me come to one issue when we regard the performance. I already said that, and you saw it on the table, that the Japanese bonds were underweighted throughout the entire time on average, as well as of latest. And we also know that the yen depreciated against the euro a lot during, if you look at the exact dates, during June 2012 until October 2014, the depreciation against the euro of the Japanese yen was 35%. So this is why we also looked at a currency hedged version of this historical simulation. And when we include hedging costs, the outperformance shrinks to 34% on an annualized basis. So still some outperformance, but a little bit lower, 34 basis points. And then, yeah, we tried to disentangle the source of outperformance a little bit more. And to be honest, having a lower weight in Japan, so in Japanese bonds, during a time where the carry was quite low on these bonds, as well as there wasn't the big price actions compared to other markets, this may explain some of the outperformance that we see here. So we gave the role of Japan within the strategy a whole section when you look at the white paper. So the white paper you find at our website, please have a look. And in this white paper, we wrote a whole section about the Japanese bonds. Okay, but then let me quickly summarize it. We have a different weighting scheme here. We think that is very promising because you have a higher diversification and better credit ratings, and also you have this tilt towards economic, environmentally friendly investing. So I think something that is interesting for those investors looking for ESG investments, but also adds some value to the portfolio. For instance, when it comes in the historical analysis to the return of a little bit higher than the benchmark, and also the lower volatility compared to the benchmark. So yeah, let me probably conclude here. Before you leave, I will open the floor for questions. So it's somewhere on your screen, I think on the right hand side, you have the possibility to raise questions. Please do so if you have any. If not, I would say let's make this planet greener together, and let's add value to the investors' portfolios. We think it is a very promising story here that we have, and we think it makes sense to release a product on it. And oh, there's one question. Yeah, let me just take it. So, oh, there are a couple actually. I don't want to read them out. Just one second. So there's one question about the weighting scheme and how the weighting scheme. Yeah. Okay. I got it. So the weighting scheme is. Yeah, I think, okay, I understand how in which direction the question to go. So the weighting scheme that we used, we were, to be very, very honest, maybe we were a little bit lucky that it turned out so well, but also, as I said, we have some sort of a size control because we level it with the overall production capacity of a country in the field of renewable, right? So a very small country cannot establish a massive amount of capacity in renewables, so we have a size control. But still, it's a bit uncommon to do it this way, and so we are working right now and on another version of the strategy in which we use the benchmark weights, and then we give points towards the countries that do more in renewables or less in renewables, and coming from this benchmark, we move to the left and to the right. For instance, as you saw in Canada, Canada has a benchmark weight of lower than 2%, but in our strategy, it has a weight of higher than 10%. And this could be, when it comes to liquidity and when it comes to real money investments, could be an issue. So what we do with Canada, for instance, we just allow that when a country has less than 2% in the benchmark, we just allow a deviation from the benchmark of, let's say, 5%, so that we have borders here, some weight constraints, and we are working on that. I think this probably answers the question. Yes, so yeah, definitely. So the question was directly towards country specific limits. This is what we're working on right now. So if you look at the, yeah, we publish it. So there you see the question in the thread. So if you have more questions, please reach out to us. You know where to reach us. You have it here on the slide again. So feel free to come to us, give us a call, send us an email, and yeah, regarding this, but also any other issue, feel free to contact us whenever it suits you. And thank you very much for being on our webinar.